are certain market phenomena that are not logical, and these are not big movers of a portfolio. We don't take these into account when we're managing people's money, but I'm just adding them in just because it's just interesting to know.
And sometimes they get talked about.
Yeah. So the first one is the January effect. Basically, on average, a lot of times there's this effect where stock prices and the stock market will go down in December and then go up in January. There's another one called.
It doesn't really make any sense. There's no real logical
none of these
for that to happen.
Some people will say that it's because people are selling to do tax harvesting in December and then buying back in January. But there's different countries that don't have our same tax laws that experience this same phenomena. Okay. And then there's the neglected companies effect. That's basically saying that companies that aren't followed by a lot of analysts tend to have better growth and performance than companies that are followed by a lot of analysts. And the last
Which doesn't make sense either.
Right. They're kind of the underdog companies. The last one is the weekend effect, and that's that prices tend to peak on Fridays and dip on Mondays, which is also interesting. So not big movers, not something to
bet the farm on.
No, but just interesting things to note and to keep in mind when you're looking at stuff.
And there are certain things that do hurt the market. And we want to briefly talk about the certain things that actually do hurt the market, most of which have to do with, they all have to do ultimately with the government, is things that hurt the market. And so tax increases will hurt the market. You know, for instance, President Biden's proposed tax increases for 2025 on corporate income taxes would increase taxes on corporate earnings from 21% where they are currently to 28%. That's pretty significant. When taxes are increased on companies, that's a cost that reduces profit. Something that reduces a company's earnings or profit reduces their value. So that's a negative for the stock market. Another significant one is it's been proposed to increase the federal capital gains tax rate from the current top level of 20% to almost 40%. That will disincentivize, I think that's a word, de-incentivize, unincentivize. It's the opposite of incentivizing investment for taxpayers.
And so, obviously that would be harmful for the stock market if people don't want to invest in it or feel like they are kind of being penalized for investing.
Or certainly it's also even been proposed to tax unrealized capital gains. And like if you have a stock or a farm that goes up in value a certain percent, whatever amount it went up in value in a year, but you didn't sell it, which causes a realized capital gains, which is when they're taxed now. The government is proposing we'll tax you on that it went up, but that you didn't sell it. So anytime there's a tax, it's an increase in tax. Generally, it's not good for the stock market.
Yeah. And it doesn't end up just being taxed. They act like it's only a tax on wealthy people. It trickles down and it's on everybody. It never ends up just being that rich people get taxed more. That's not reality. The second thing is prolonged inflation and high interest rates.
Eventually, inflation causes interest rates to get up high enough that it does end up affecting the stock market. It affects the stock market in two ways, Jesse. One is because most of these companies borrow money. And as interest rates go up, their cost of borrowing goes up, which just like taxes affecting profits, a higher cost for borrowing money reduces their earnings too. But then the other thing is that once interest rates get pretty high, then some people wisely move some of their money out of the stock market into interest-paying things. For instance, like one of our strategies is that we're thinking about right now. If interest rates continue to go up, and if if history repeats itself, and like in 1981, when we had peak interest rates before, home mortgage rates were 18% for a 30-year mortgage, but 30-year treasuries, 30-year federal treasury bonds were paying 12%, 12% locked in for 30 years. We might move some money from some accounts, 10, 20, 30%, take it out of the stock market and put it there. We're not there yet, but could happen.
All right. And then the last thing that could hurt the stock market is increased regulations and compliance.
Anytime the government comes up with new regulations on a business, it costs them money to comply with that regulation, because they got to, pay for software, they got to pay for people to do it, or it takes time to follow that regulation. So some people, particularly in the government, just don't think there's enough rules, and they like to increase regulation. So those three things: excessive taxes, prolonged inflation, and high interest rates, and increased regulations, are things that do hurt the stock market.
Mm-hmm. Okay, so let's review the 5 things that you may have never known. Number 1, current events effects on the market are temporary and overblown.
Number 2, market timing is a mistake, not a method.
Number 3, investing doesn't need to be complicated. Simple strategies win.
Number 4, there isn't a specific formula for investing once you retire.
And lastly, there are certain market phenomena that are anomalies, but they aren't big movers.